when are interest rates finally going to start to fall? It's a question on everyone's minds at the moment, a lot of people's minds at the moment, as increases have been obviously eating up a lot of disposable income, if not all disposable income over recent years. The irony of the whole situation is what you wish for. So obviously homeowners and investors would like the interest rate to decline. That way the holding cost of the property reduces and takes stress and pressure off the situation. But to do that, you have to understand that that's the RBA's main lever. And I'd say they maybe overuse it, underuse it to the extreme sometimes, but that's their lever to control inflation. There are other ways to control inflation, but it's more a government thing. So RBA, government, separate entities. But the government could stop giving out free money, that would help with inflation. But RBA, that's their lever. So understanding that's what they're trying to use to control the inflation situation. You have to understand that the reason it got so cheap was because they reduced it to incentivize activity. The market was obviously overnight, if you can remember that little 6 month scary window where we thought the world was actually ending, everything kind of stopped. So to reduce that to that level, got investors and owners back in the market and stimulated the economy again. So we're on the opposite end of that now. There's been lots of activity, lots of inflation. House prices, are very high and gone up a lot, and same with literally everything else. So they're looking at, look, how far do we have to go? Or when can we back it off? The other side of the equation is, when does it require it? When is there not enough activity in the market to require that nudge from the RBA? So the irony is, when you're asking for a reduction in rates, you're also asking for a sort of a decline in the market conditions, which is fine by me, but I'd rather, properties be cheaper and easier to buy, better cash flow. But yeah, just understanding that equation, but also understanding why when we're not seeing that. Because in my opinion, that decline or that reduction in rates is going to come a lot later than people think. The reason for that is things are good. There's lots of activity in the market, especially in the places that we're buying. People are paying top dollar, buying at very low yield, so the rental income versus the purchase price is very low. Not acceptable in, normally if you went back to the interest rate conditions or this interest rates back in the past, these yields wouldn't have been heard of. So it's a lot of confidence in the market that interest rates are going to come down in the near future. A lot of people talking, late this year, last year, they were talking early this year. It's just theories at the moment. Even when the RBA said they're going to do something, like not increase rate for 3 years, which they did, and then they come and increase it, 18 months in. Nothing's ever for certain, but just understanding that pushing is pushing off the reduction of rates. When buyers are out there inflating prices, buying with the assumption that rates are going to reduce, that just doesn't give the RBA any insight into when they should pull the trigger or why they need to, if there's so much activity in the market. The other big shift, I think you probably call it culturally, we've seen is like valuing the experiences in life, like the luxuries, the extras. It feels like, I don't know, in our lucky country that we've got survival sorted. I know it's not the case for everyone, but it does feel quite comfortable for a lot of people. The reason inflation has been so high and has stayed so high is that people were spending a lot of money. Using the figures, obviously it's on a decline at the moment, but when people spend money, prices go up, and that's not just property, that's all areas of the marketplace. It's, I think, a change in maybe a cultural attitude, is that, hey, these luxuries, these extras, we value them to the point where we're happy to spend whatever it costs. And whether that means, less savings for a rainy day, whatever it is, or even overextending ourselves a lot with, buy now, pay later kind of options available. And we're valuing that, we're valuing the experience, we're valuing the travel, grabbing a credit card and going on travel. Those things push the inflation even further. And I think the main driver of this attitude is just like a lack of exposure, especially for us millennials, to those sort of bad situations. 2008 was kind of the last sort of big scary thing that we saw that had an impact on the economy, and that was, we still kind of got bored out of that with, handouts and that kind of thing. But obviously a lot of people early in their careers then, or not yet in their careers, so you didn't have home loans, didn't have mortgages, that kind of stuff. So didn't understand, we didn't have that, we need that dollar for the home loan. And today, more recently, we had COVID, which was supposed to be the worst thing ever, world pandemic, which is a big deal. Economies probably shouldn't flourish during those times. We've come out of it very strong. Money was free, job keep, all that kind of stuff, like mortgage holidays, like you couldn't pay your loan repayments, the banks would just take 6 months off, it's all good, we'll wrap it up and get it back many times over later. But like, there was none of that, like there was a lot less, and the struggle that was experienced is very quiet. We don't hear about a lot of that, apart from the odd clickbait title. So yeah, I think just that attitude or that lack of experience around what it could look like, what worst case scenario is just not there for us. We don't have that lens. It's more just, we just go out there, do our thing, enjoy our lives, and things just keep getting better. And so I think that's a big shift we've seen from sort of back in the day when you did have to, even on get a little bit political, but like on a company level, large companies, the savings thing isn't really there when there's a lot of bailouts around. So we have that attitude of just do more, be more, experience more, without that much concern for the downside, because we haven't been punished by it. And I think that sort of reaffirmed as well by young people saying, look, I'm not going to be able to afford a house, which I can have a controversial 2 cents on that and say that's a bit of an excuse to, just to keep enjoying life and do the things that matter to them, which is the travel and the fun stuff. Do that because I don't have to save for a home if I do that. And it's also, socially acceptable to dislike the current price of property. So anyway, as another topic, but I think that attitude then feeds into the inflation of goods and services and products and that kind of stuff. So when the RBA is again looking for a reason to stimulate more activity, we're already doing that. Like, we're already spending our savings, we're already doing those kind of things. So I think that's sort of what's going to keep pushing that off. The other ironic part of it all, as an investor or homeowner that owns a property, more so investors, inflation's what you want. Like, you want the prices to go up, you want your rents to go up, and that's a whole nother debate around the rental crisis. But you want those numbers to go up, especially if they're multiple times your own expenses or current property value. So those expenses there are compounding on a smaller number versus your upside on your bigger portfolio. That's literally the whole property game. You want to see that outpace growth by your investments compared to your own expenses. So there's a few things to consider there, but it's just a bit like, I'm kind of advocating for just play your own game. Set your criteria for what a good investment looks like. If it's not available in the market, don't buy it. Keep looking for it until you do. Buy with your buffers in place. Prepare for the downside, even if it never comes and we keep getting bailed out. I'd rather be prepared for the downside, have a lesser upside than bet the house. So yeah, that's kind of my opinion on it all. Play the game with what we have available. Buy deals based on their current situation. Don't buy something with the hopes that it's going to be 2% cheaper to hold the property. That's speculating in my opinion. Yeah, so no numbers. Buy what works in today's market, pay today's prices, collect today's yields, allow your buffers on either side of that, and I think you'll do well long term.